Well, hello and welcome to this Moneycontrol live stream. You're watching Morning Trade with me, Nandita Khemka. Well, over the next 30 minutes, we'll be talking about the market trends, the sectors that will be in focus, and also the stocks to watch out for in today's session. We'll also be addressing all your stock-related queries with our experts on the show. So keep commenting on our live feed, and we will have them addressed by our expert on the show. Siddarth Bhamre of Religare Broking joining us this morning. Good morning, Siddarth. Good to have you on the show as always. Before we move on to the markets, I want to get in your thoughts on the extension in the trading timing for interest rate derivatives that NSE has announced. Now we know that this will benefit retail traders as they will get, they will be able to react quickly to all the global updates after the market hours, right? But how would this move? What would this move mean for brokerages?
Well, not much, Nandita. Firstly, thanks for inviting me on your show. So interest rate means we are talking about timings related to banks, and banks anyway function till till evening. So this is just bringing it in line with banking space, and of course, interest rates derivatives, they don't have much of volume from a retail perspective. Our market is not yet too matured over there. So interest rate derivatives and equity are two different things, and I think it won't impact retail in big way.
Right. Let's now talk about the markets then, Sid. Markets, as we all know, have been stuck in that 17,800 to 18,000 range ever since the budget on 1st Feb. Now we have the FNO expiry tomorrow, and there's been a lot of volatility. In fact, markets may slip, in fact, even below that 17,800 this mark this morning. So how would you advise investors to play the markets at this juncture? What should the strategy be? Buy on dips?
See, Narita, firstly, be it investors, traders, this market is stuck in a range. Investor who has a time horizon of 1 to 3 years, this market has not gone anywhere since last 1 to 3 years. Within trading community also, you can have positional traders who have, 1 month, 2 months view. Since last 1 month, market is in a range where, the 17,500, 600 is support and 18,200, 300 is resistance. And from very short-term perspective, also market is in a range. And in a range-bound market, either you make some index derivative strategies where it benefits you when market remains in range, or you be stock-specific. As far as I think investors and viewers would be more interested to know that when this range will break and which direction it would break. See, at this point of time, the positive triggers for these markets are very less. Either we look for global cues, either we look for falling commodity prices or falling interest rates, or we look for earnings for this market to get a direction. Now, globally, nothing much is happening. In fact, they were outperforming. And why they were outperforming? Because before that, we outperformed substantially when they were suffering. So there is some catch-up role which is happening. Now, even that catch-up, we are seeing that Dow is showing signs of weakness. So overall, the positive triggers are not that great. Even if you look at earnings, it was not a great season as such. Yes, there was some disappointment. Some names were like in line with expectations, but there was no major positive surprises barring 1 or 2 spaces. So earning support is also not there. And that's the reason you need something to happen. FI's liquidity point of view, even they are, positionally short on this market. So one thing is very clear that upside is limited and downside, maybe it's there. We're not very sure about it. So in this kind of market, you have to be stock specific and sector specific. And that is what the strategy we are adopting.
Well, need to be stock specific in this market. Now, last time when I spoke to you during Diwali, I remember you had picked up HCL Tech as one of your picks. And this year, we've seen IT index make a strong comeback. In fact, if you look at shares like Tech Mahindra, they've given double-digit returns so far this year. Would you retain your view on IT? Do you think this rally will continue through the year?
Well, I don't know through the year because, situations are changing very fast, Nandita. All depends on, how US will pan out and how Fed would react to it. Because if the interest rates in US goes up substantially, then I think everything over there would suffer because already interest rates over there are at historical highs. And why I'm talking about US market, because IT is 80%, 75% of businesses come from that space. So far, IT stocks have been doing well. What we had envisaged that IT stocks, when they were correcting because there were problems in US, and also the manpower cost was going through the roof, which was impacting their margins. We had anticipated that the problem in US was not just from a very long term perspective, and people were spending on IT to do cost optimization. So IT business was flowing, and this manpower cost thing is not going to remain forever. It was a cycle which lasted for 1 year, and now we are seeing that how manpower cost is coming down, attrition levels are coming down in IT, and this would give some fade to investors, and they would start coming back into IT. Now that theme is playing out. It has not completely played out. It's playing out. So we might see that outperformance in IT might continue, and we have Infosys, HCL Tech as our preferred picks over there in large cap space.
Well, Infosys and HCL Tech preferred picks in the IT basket. Siddarth, is the rally in banks as good as over? Because that pocket has been under severe pressure since the last few weeks. Would you expect more pressure to come in when it comes to this sector?
See, banking is not doing good. I think this is clear to all. It may continue to remain under pressure, or maybe just consolidate. But then I don't have very clear-cut opinion, to be very honest, Nadira, that how long banking would continue to underperform. But because of underperformance of banking, there are some very prominent trades which are emerging, and I would like to dwell more into it. We all know that banking and finance constitute around 40% of index, and people are generally overweight because of the growth they show. And now with this 40 to 45% of your funds AUM underperforming, what fund managers are doing, Nandita, is that they are shifting the weightages. And even if you shift, 2-3% of weightages, you will have to, go into other space. Now, which are the other big spaces? I don't think so. People are very upbeat on metals, and even if you talk about metals, then there are hardly few names. Telecom, you have 1 or 2 stocks. Even those names are not doing that great. At least one name is not doing that great. The other name is doing well. Then infrastructure, you have L&T among large cap space. That is where the allocation is happening. And then you see that that stock is outperforming. Within infrastructure space, what we are liking is cement. See, why I am talking about cement when you ask me a question about banking is because banking is underperforming. And the funds would get diverted to other sector. Ultimately, people who want to make money can make money out of any space. And the disadvantage of banking is going to work in favor of some of the sectors. So in cement space, you know that, a couple of big names are under fire because of their recent acquisition, or if I have to be very direct, ACC Ambuja people may not touch immediately because of what's happening. Then the only large cap name left for you is Ultratech Cement. You need to have exposure over there because cement, not just from the disadvantage of banking, but overall cement space is growing, capacity expansion is happening, the input cost pressures are coming down. We are going to revise our target price in Ultratech upwards. So that is one space. The other space is auto. Now, not all auto space are doing well. Nandita, last time also we mentioned that Maruti is a preferred name because last 5 years the stock has underperformed because there was no series of launch of products. And now see how many products Maruti is launching. Even if its market share, which came down from 52 to 43%, goes to 47, 48%, I think we are going to see a substantial return generated in stock of Maruti. So these are few ideas which we feel will get more focus by investors because banking is not doing well. And within banking space, I think people have overreacted to what has happened to SBI because of some exposure towards an Adani Group. That exposure on the overall balance sheet of bank is not very substantial, and market has overreacted. We are still in the nascent stages of capacity expansion and credit offtake growth, which will benefit to stock like SBI. So dips in SBI is one stock where we are suggesting to buy on dips in banking space.
So SBI, we spoke about autos, we spoke about the cement basket. Any other pocket that investors should be chasing in this kind of a market, Sid?
See, firstly, this is not a market where you have to chase because you're not in a momentum market. And when you're in a momentum market, that is where, we should not wait for dips. We should chase stocks. There will be a dip. All these names which I spoke about, even these names will show you dip. And they did show a dip. because we are not in a momentum market. The other space which I feel will benefit because the way the announcements have happened in budget, the focus on rural economy is FMCG space. Mind you, valuations are not very attractive, but then when market or any stock has traded for a long time on a fair value at a fair value zone. ITC is something which we're liking. We're liking Britannia. We're also liking some other names like HUL and Godrej Consumer. But ITC and Britannia would be favored names in FMCG basket as such.
Right, Sid, with that, we are running out of time. So thanks a lot for taking out time and joining us this morning. It was a pleasure chatting with you.
Thank you, Nandita. Thank you for inviting me.
Thanks. It's a wrap on this edition of Morning Trade, but coming up next is Opening Bell, so don't go anywhere.